Hello everyone, Melinda Chapman with Values Driven Realty and United Financial Freedom. I'm the realtor that can not only sell you a home, but I can show you how to pay it off and all your other debt in a fraction of the time because we can save you scheduled interest dollars. Those are dollars that you're scheduled to pay your bank right now, but we can cancel that out and save you tens, if not hundreds of thousands of dollars. Keep it in your pocket where it belongs instead of the bank's. So this is my segment 2 of financial literacy, and it kind of got prompted by some posts that I've seen recently from some different mortgage lending companies that just kind of really stoked a fire in my belly. And I just felt the need to just kind of come on and talk about just the banking industry as a whole and mortgages and just how they're structured, and really honestly just how we're being disadvantaged by them. And you know, we know what we know and we don't know what we don't know, and I just don't like seeing people be in the dark about things and being disadvantaged. So that was kind of what prompted me to do this. So if you didn't catch segment 1, make sure you go back and check my YouTube channel. I'll have that posted in the post here, my link, but check that out. But anyway, we talked about mortgage. We took a look at the whole breakdown of the word mortgage. And now we're going to take a look at amortization, because mort is in mortgage, mort is in amortization. And we're going to take a look at the amortization loan, basically. So back in the 70s, we talked about how the banks just changed everything up and they went from simple interest loans to these amortized loans. And there's different types of loans. We have open-end loans, we have closed-end loans, and there's a big difference between the two. So an amortized loan is a closed-end loan. Now, what do I mean by that? Well, it means you can only pay into that. That means we can't take money back out. Like, for example, with a credit card, we pay into it, we can take money back out. We pay, we take money back out. Home equity line of credit, we can do the same thing, right? But with car loans, those are amortized loans. Our mortgages, those are amortized loans. We can only pay into those. So in the case of the amortized loan, it's 360 months in the case of a 30-year loan of pre-scheduled monthly payments. In other words, you know exactly, if you go back and you pull out that amortization schedule that you received at closing, you know exactly what you're scheduled to pay in principal and interest every single month, okay? So another thing they did was they did their homework. And I will give credit where credit's due. The banks they know what they're doing. There's a reason they have the largest building in every major city, because they do know what they're doing. They know how to make money, and they know how to make money off of us. They make money off of our money. And so in all of their research, they discovered that people only stay in their homes on average 5 to 7 years. And during that time, they're either gonna sell their home or they're gonna refinance. So in their never-ending quest, again, to get more profit, they wanted to get the majority of that profit during that time frame. So they not only changed to amortized loans, but they also front-end loaded those amortized loans with interest, meaning that the first 5 to 7 years of that amortized loan is front-end loaded with interest. Now, what do I mean? I'll give you a real world example here. So let's say we've got a mortgage that's at $350,000, okay? So, and we'll say it's at 3.5%. And I know that's a little lower than today's rates, but I'm just trying to keep my numbers simple here. The payment's going to be roughly $1,571 a month. That's just a principal and interest payment. We're not talking taxes and insurance. So the very first payment, $1,020 and some odd cents, is going to go to interest. Of that $1,571 that you're paying to the bank, $1,020 and some odd cents is going to interest. Now, first of all, I would ask you, how is that 3.5%? But we'll save that discussion for another time. So that means that they are getting their profit up front, which leaves very little room for us to build any kind of equity, right? For at least the first 5 to 7 years, because we're paying all of that interest up front, correct? So that's how they get theirs, if you will. So keep in mind, amortized loans, they're closed-end loans, pre-scheduled payments. All that interest is being paid up front. But here's the good news. We have an equity accelerator that allows us to cancel that scheduled interest. And when we cancel interest off the front end of the loan, it shaves time off the back end of the loan. So our clients can pay off their mortgage and any other debt on top of that in as little as 5 to 10 years, saving them tens of thousands, often hundreds of thousands of those scheduled interest dollars, keeping those dollars where they belong, in their pocket instead of the bank's. So imagine if someone came up to you and said, yeah, you owe the bank $186,000 in interest, but guess what? You don't have to pay that to them anymore. How would that change your life? If you knew you were contractually supposed to pay the bank $186,000 in interest, but now you don't have to. You get to keep that in your pocket. Oh, and by the way, we're going to knock 20 plus years off your total debt service. I mean, that's pretty life-changing, right? So anyway, that's enough for today's segment on financial literacy. Thank you so much for joining me. Again, if you didn't catch segment 1, check my Facebook page or my YouTube channel. I will be making a segment 3. We're just going to continue to plug away and learn more about the banking industry and just kind of expose some of their little banking secrets that, guess what, we now can use to our advantage to help create wealth for us instead of giving them all the profits. So thanks again for joining me. Have a super blessed day, and remember how much God loves you. Bye-bye.